Welcome back to the Noob Selling Options channel. I am absolutely thrilled to have you with us today for this brand new explainer. Look, we are going to dive straight into NVIDIA's staggering Q1 fiscal 2027 blowout earnings. But we're not just looking in the rearview mirror today, we're actually going to project this forward. We are going to use grounded, highly conservative math to show you exactly how this company has a very realistic path to a $7.2 trillion market cap over the next 3 years. So, if you're the kind of person who loves stripping away the market hype and just focusing strictly on the raw numbers, you are absolutely in the right place. Let's get right to it. Here is our roadmap for today. We're starting with the Q1 FY 2027 blowout, then moving into the data center and shareholder rewards. After that, we'll map out the 3-year growth outlook, crunch that conservative valuation math together, and finally look at what it takes to actually reach that $7.2 trillion market cap. All right, Section 1, the Q1 FY 2027 blowout. And wow, what a massive revenue beat this was. Now, going into this earnings report, the bar was set incredibly high, right? Wall Street was essentially looking for an infrastructure cliff. They thought the spending would stall. But instead, we got $81.6 billion in revenue for a single quarter. Think about that for a second. That is an 85% year-over-year surge. It comfortably crushed the street's expectations of $79.1 billion, completely outpacing NVIDIA's own guidance. The sheer scale of revenue acceleration happening here is, quite frankly, historic. But what's even more fascinating is how that massive top-line revenue actually trickles down. Adjusted earnings per share came in at $1.87. That is a mind-blowing 140% jump year over year, completely blowing past what the analysts were forecasting. So what does this actually tell us? It shows that NVIDIA has achieved incredible operating leverage. They aren't just selling more chips, they're taking that accelerating top-line revenue and turning it into pure, concentrated net income. And speaking of turning revenue into pure cash, you've got to look at these margins. Despite the mounting complexities of global supply chains and building these incredibly advanced chips, NVIDIA held firm at a highly profitable 75% gross margin. Because they have that undeniable pricing power, they generated a record $49 billion in free cash flow in just one quarter. Just to put that into perspective for you, they jumped from $35 billion in Q4 up to $49 billion in Q1. They are quite literally printing cash right now. Moving into Section 2, let's take a look at the data center and how they are returning all this cash to shareholders. This whole blowout is being driven almost entirely by the data center division, which, by the way, now makes up over 90% of their total revenue. Out of the $75.2 billion from the data center, $60 billion of that is coming directly from compute. That's the hyperscalers making that massive transition from traditional CPUs over to GPUs. But do not ignore that networking segment at $15 billion. That part of the business nearly tripled year over year. Management was quick to highlight that Spectrum-X, which is their purpose-built Ethernet platform for AI, has grown so fast that its footprint is now larger than all other Ethernet networking peers combined. So, what do you do with an absolute ocean of free cash flow? Well, NVIDIA's board announced a massive, upscaled capital return program. They authorized a brand new $80 billion stock repurchase program, and they hiked the quarterly dividend by 24 times, bringing it up to 25 cents per share. Now, obviously, we both know you don't buy a mega-cap tech growth stock just to collect a $1 a month annualized dividend. But what this really signals is massive, unwavering confidence from Jensen Huang and the entire board when it comes to the long-term stability of those cash flows. Let's pivot to Section 3, the 3-year growth outlook. We are officially entering a new, steady phase. Because NVIDIA is now working off such a massive financial base, we're naturally shifting from that triple-digit hypergrowth phase into a steady compounding phase. Wall Street's consensus outlook currently projects annualized compound growth somewhere in the mid-20% range across earnings, EPS, and revenue. Now, sure, a 24% growth rate might look a little slow if you're comparing it to last year's 100% spikes. But let's be real here. Compounding an annual net income base of over $120 billion at over 20% per year is almost entirely unprecedented in modern corporate history. Let's actually trace how this trajectory builds out year by year. Fiscal 2027 is really the heavy lifting acceleration year, driven by the Blackwell cycle, with revenue tracking all the way up to around $373 billion. That is being fueled by an estimated $725 billion in collective AI capital expenditures from hyperscalers like Microsoft, Alphabet, Meta, and Amazon. Fast forward to FY 2028, and revenue expands toward that incredible $500 billion mark as the Blackwell cycle matures. And by FY 2029, we are looking at top-line projections stretching up to $607 billion, completely paving the way for the eventual next-generation architectures. All right, Section 4, the conservative valuation math. It's time to establish a strict margin of safety. Now, here at Noob Selling Options, we don't just blindly trust the most optimistic projections out there. We need a solid steelman argument. So first, let's actually drop that mid-20s growth estimate down. And we're going to anchor our expected growth rate at exactly 19.0%. Doing this accounts for real-world risks. Things like hyperscalers lengthening their replacement cycles, competition from AMD, or custom silicon chips coming out of Google or Meta. Next up, using a strict PEG ratio of 1.0, our target PE multiple automatically compresses down to match that growth cap. That gives us a 19.0x PE. Finally, we take Wall Street's projected FY 2030 EPS, which is currently sitting at roughly $16.50 per share. So now we just execute the formula. We take our target PE multiple of 19.0 and multiply it by our projected EPS of $16.50. That gives us a mathematically grounded 3-year target stock price of $313.50. Think about what we just did. By significantly tightening our assumptions and capping that valuation multiple at a really modest 19x, we have completely stripped away the speculative premium. We're essentially valuing NVIDIA strictly as a mature, highly efficient cash cow utility for global computing. Which brings us to our final section, Section 5, reaching a $7.2 trillion market cap and the corporate finance mechanics behind it. Comparing these two scenarios is super eye-opening. As of Q1, NVIDIA had roughly 24.22 billion shares outstanding. Now, if that share count stayed exactly the same, our $313.50 price target would equal a $7.6 trillion market cap. But remember that massive $80 billion buyback program we talked about earlier? Over the next 3 years, as NVIDIA aggressively pulls its shares off the open market, that outstanding share count is going to drop. If it drops to, let's say, 23 billion shares, the stock hits our exact $313.50 target price at a significantly lower corporate market cap of roughly $7.2 trillion. So the buybacks are actively lowering the ceiling required for us to hit that target price. So what should you actually take away from this for your own portfolio today? Well, with the stock currently trading around $224, this highly conservative model gives us a total expected return of about 40%, which works out to roughly 11.9% annualized. But the real magic here is that built-in de-risking we did. We are literally factoring in a massive 28% drop in its valuation multiple. Even if the broader market totally strips away NVIDIA's premium valuation, the sheer volume of that underlying raw earnings growth creates a mathematical floor that pulls the stock price up over time anyway. Listen, if you appreciate this kind of grounded, numbers-first analysis, please do me a huge favor. Hit that like button and subscribe to the Noob Selling Options channel right now so we can keep diving deep into these explainer topics together. Before we wrap up, I want to leave you with one final, incredibly provocative thought. Everything we just walked through today, the 19% growth cap, the compressed multiple, that was our worst-case, highly conservative math, and it's based primarily on the current Blackwell cycle. But management is already teasing their next-generation architecture, the Vera Rubin platform, and that promises even sharper efficiency jumps per megawatt. So ask yourself, if $7.2 trillion is the conservative worst-case floor, what happens when Vera Rubin truly scales? Thank you so much for joining me on this explainer. Keep crunching those numbers, and I will see you in the next one.